Hi, this is Soumya Sarkar from Wealth Redefine. As you know that we have done certain interviews with the fund manager. Today with us is one of the renowned fund manager of the industry, Mr. Ashish Naik from Axis Mutual Fund. Most of you are already invested in Axis funds. So we would like to know from the horse's mouth about how the Axis fund is doing, what are the expectation, and how it will become again one of the best fund in the industry. Thank you, Mr. Ashish, for joining me.
Thank you.
And if you can start with your journey towards a fund manager, where you have started, how you become a fund manager.
Thank you very much for having me here, Mr. Soumya, and hello everybody. So yes, from my journey towards being an equity fund manager, actually started post my engineering and a few years in IT industry. I completed my education from one of the B schools in India in about 2007. Post that, I joined MNC firm on a brokerage side called as Goldman Sachs, where I was part of the banking team. Initially, it was based out of the Asia Pacific financials team, and then eventually I moved to Mumbai, which was largely on the Indian banking space, where I was supporting the existing analyst, lead analyst for banks there. After that, it was in 2009 that I got an opportunity where Axis Mutual Fund was just starting as an AMC under the able leadership of Mr. Rajiv Anand, who had basically worked in Standard Chartered and then IDFC Mutual Fund, and post that he had joined Axis Mutual Fund as the CEO, and I was actually recruited by Mr. Chandresh Nigam, who was my immediate manager as a head of equity. I joined as an analyst, covered various sectors, and as the team kept growing, there were other fund managers who joined in, and I got opportunity to cover various other sectors, so starting from cement to agrochemicals to metals, pharma, autos, logistics, a lot of them. So there's a lot of exposure and opportunity to understand various industries, how these sectors work, and what are the sort of winning formulas. As you would know, Axis as a mutual fund has always looked at quality and growth as a key investment philosophy, where we try to find businesses that are sustainable over longer term, and these are the sort of businesses that grow and move from, let's say, small cap to a mid cap to a large cap, and then eventually many of them have become part of Nifty. So that shows that the success strategy here is to find long-term sustainable stories, but there is also a lot of study that goes into the business models, the kind of management pedigree, the track record of the promoter, and obviously many other things which are related to governance and other such factors which are also equally important. Something these are one can say these are soft issues. But as from my journey post 2016, there was an opportunity for me with some changes in the team where I got to start managing a few of the funds on the hybrid side. 2018, we also launched the first the NFO for our aggressive hybrid fund, which I got an opportunity to manage. 2020, another NFO in terms of special situations was launched, and just this year in February, we also launched the business cycles fund. So have managed a slew of funds in Axis, been with the team for about 14 years now, and it's been a great journey till now. Sure.
Thank you, Mr. Naik, for giving us this insightful opinion about it. So you are co-managing the Axis Bluechip Fund as well.
Yes.
And Axis Bluechip, we have picked up Axis Bluechip in 2017 late or 18 starting, when we found that there is a lot of opportunities, the fund is being very well managed. Suddenly we see there is a downside in 2022. What was the reason, and whether the fund was too big to manage, or there are opportunities which were not there in the market? What exactly happened, and how you think it is going to reverse? And we have seen that it is reversing, but it is doing well now, back into the track. But what went wrong, and how you people have make it again is one of the best fund in the industry?
Great question. But just to answer that, I'll probably have to go slightly deeper into what exactly we do as a fund house, right? Axis Bluechip Fund is the flagship fund, is the fund that was first launched by Axis Mutual Fund back in 2009 December for first NFO. We have seen it grow from zero AUM to where it is today. And as you rightly said, there were obviously periods of great outperformance across the years, especially a large part of last decade. If you recall, economic growth was relatively lower, and hence the focus of most of the industry, including the valuations that a lot of businesses got, were for companies that were able to sustainably grow in a difficult growth environment. Post 2016, economic growth was much lower, and hence the opportunities for growth were very few, especially towards large caps, and even in the large caps, in particular sectors and players in those sectors that are able to gain market share. So that is exactly where the Axis philosophy of growth and quality completely aligned to, and hence there was, I would say, a sort of disproportionate benefit that we had and we enjoyed during those years, all the way from 2017 to 2020, including if I have to start from 2010, there were patches where growth and quality have outperformed for many years. But there have been some times where our philosophy has probably not outperformed, and something like a philosophy which is slightly different from this in terms of investing into stocks based on lower valuations, which are basically called as value stocks, have outperformed. Many of our funds, including the Blue Chip Fund, does not have a huge amount of tilt towards the value style, and hence we are underperformed in those periods. So for instance, 2013, 2016 were maybe a period of 6 to 12 months where we did not do well. But clearly, post 2017 to 20, it was, I would say, a golden period for us. And consistently, markets and investors started looking at the concentrated portfolios, and the market, if you remember, at that point of time by 2020 was highly focused and concentrated on a few particular stocks, and thankfully we had a lot of them. That was that. Post the COVID crisis, we could see that market has started to slowly move towards value kind of style. One of the reasons was the relative huge underperformance that it had versus growth quality, and obviously we knew that, and we had communicated it to various investors that such periods have happened in the past, and one needs to understand that
Yes.
there can be periods of underperformance for our fund also. Another main reason why growth quality has underperformed after 2020 was largely because of what happens on the interest rate side. So just to go to the basics, the way you value a company in terms of, let's say, what we call as the cash flow, discounted cash flow analysis, any growth that is there in the future is actually discounted at a certain discounting factor which is related to the interest rates, and interest rates comes into the denominator, which means higher interest rates will bring the present value of growth lower. So which is why whenever interest rates are going higher, the value of growth companies starts getting lower, which means the PE of a growth company falls. The exact opposite happened between 2017 to 20, where interest rates were lower. If you remember, there were countries which had negative and zero interest rates at that point of time, and hence the growth companies got a huge outperformance and valuations. The exact opposite happened in a period of high inflation that we have seen for the last 2 years, where even US had a higher inflation than countries like India for a period, and the geopolitical crisis in Europe did not help the situation at all. In a matter of few months, US had increased interest rates all the way from 0 to 5%, and they have consistently kept it higher. This is a period where growth stocks generally tend to underperform, and if I have to give a global example, even an index of high growth and high technology stocks like Nasdaq has been underperforming in this period. Clearly, that is also results in outflows from foreign investors, and a lot of FIIs have a tilt towards growth quality when they invest into a high growth market like India. So that has also not helped in terms of flow. So all of these factors generally we have seen in the past also result into Indian market underperforming. But the fact that there have been outperformance of Indian market versus global markets, and the mid cap and small caps in the Indian market versus large caps, is largely driven by domestic flows. We've seen huge amount of mutual fund and PMS and other flows, retail flows into the market, which has actually driven Indian markets in a different direction than what has been happening globally in this low growth, high inflation kind of period. We expect that a lot of these things are temporary. We don't see that this kind of high inflation will continue for a persistently long time, and as and when these conditions reverse, we believe that the growth and quality style, which has outperformed over a period of time, should come back, and hence even a fund like the Blue Chip Fund should also see better days. Having said that, we have made certain changes. wherever we found that post 2019-20, there are newer opportunities in the market, newer businesses that are doing well from a medium term in terms of growth and quality, we have included them, and hence the number of investments that is there in a fund like Blue Chip Fund has increased. Your question about the size of the fund, we feel that in the large cap space in India today, there is enough liquidity available for a fund of this size, and we have done our internal analysis. The leeway for such a fund to grow from here on also remains in terms of buying and selling stocks as and when the need arises from the fund management perspective. So from that perspective, size being a constraint, we don't think that is really the case for a fund like a blue chip fund, even at this size.
Okay, so it's a generically a very good answer from your side. Thank you for giving such a detailed explanation. But for a fund house perspective or fund perspective, even 6 months or 1 year of underperformance is a big deal.
Sure,
because for an investor perspective, it may not be the big deal because he has a goal-based investment or she has a goal-based investment. But for a fund house or fund perspective, it's a big deal. Have you changed your strategy towards to accumulate the return and everything,
Sure,
to growth to value at this point of time, to some, not everything, but to some extent?
No, so absolutely, it's a fair question. What we have been analyzing, and I think one of the most important things from a fund manager's perspective is when they build the fund, what are the ultimate stocks that we are investing into, what are the companies that we are investing into, and are these companies and businesses doing what they're expected to do, right? I mean, we expect a certain level of growth, a certain level of profitability in terms of return on equity and other cash flow metrics. Are they delivering on that? I think in general, that has been the case. We have had difficult periods, we have had high growth recovery periods. We've seen the businesses that we have invested into have done exactly what they were expected to do, or probably better than that in their industries. So to that extent, we have not found growing need to sell these businesses or companies based on that. Having said that, yes, valuations of these companies were much higher back in 2020, maybe 2 or 3 years back. To some extent, they have narrowed. And in fact, what we have seen is businesses which were relatively lower in terms of valuations have moved higher.
Yes.
So that gap actually, which had built up quite substantially, has normalized. And it is a cycle in the markets where these gaps keep building up and then coming down. In a high growth scenario, everything seems to be outperforming, especially mid and small caps, and hence that tends to happen. But obviously, there were a lot of funds, even in our fund house, where we were supposed to have a mix of large, mid and small caps, where our tilt towards large cap was much higher in a low growth environment, in a difficult sort of scenario for the economy. As we started seeing that the economy is moving out of COVID crisis, we have successfully been able to come out of it across the country in general versus, let's say, other parts of the world. We obviously started looking at more opportunities in the mid and small cap space. We have increased the number of, let's say, for example, the number of stocks that are there across our mid cap, small cap, flexi cap strategies. And as I mentioned earlier, even in the blue chip. So a lot of our funds started looking at and, sort of broadening our base of investments. The second thing what we also did is to look at sectors which are coming up well. So large part of last decade was actually more about consumption. It was more about what areas are consumptions able to grow in, something like staples, or let's say more growth into relatively safer sort of parts of the economy like pharma or IT, or even some sectors like chemicals. But in general, a large part of which is basically manufacturing, capex, infrastructure, was pretty much lacking in terms of growth in the economy. What we started seeing this decade is that a lot of these sectors had reached a certain level of capacity. Government policies have been in general supportive of this, where we want to substitute a lot of imports, and also at the same time look at export opportunities from various subsectors and businesses in that. And that's where another set of ideas and companies were available for us to invest into, and which is exactly what we have done across our fund. So when we say we have broadened our base of companies, it's not in the same sectors. To that extent, the tilt of sectors which can become a reason for underperformance has been tackled by the team. So to that extent, we would not say that we have moved out of growth completely, but we have broadened the definitions and the spectrum of the opportunities that are available. And obviously, when we say as a basic filter for quality, Axis has its universe of stocks, which is in the range of about 360 stocks that we have right now in the investable universe, and that we believe is enough for us to invest into companies. In addition, what we say is that back in 2019, our total invested companies were about 120. Today, it's more than 200. So clearly, we have shown the ability to stay ahead in terms of whatever changes that are happening in the economy and actually reflect that in the funds at the right point of time. Having said that, a fund such as, let's say, Focus 25 is restricted to 25 stocks. So there we will not obviously be able to broad base these sort of changes. Another mention that I would just like to make here is where there are few funds in the Axis stable which are very different from the growth and quality philosophy, primarily because of the nature of these funds. With something like a value fund that we have launched about a couple of years back is completely based on the value strategy, which is looking at companies which are fundamentally undervalued and can do better from here on, and hence the investor benefits from the re-rating. The second is also the business cycle fund that we launched recently in February this year, and there we look at sectors which can do well from a 2 to 3 year perspective in terms of high growth, right? As the sector matures in terms of growth, we move from that sector to another sector. So something like an FMCG might not be prominently present in such a fund, where if we can find other sectors that can do better than that. And generally in an expansionary economy where we are starting to see new manufacturing cycle sort of grow, there are a lot of such opportunities that are available. Both these funds, value as well as business cycle, have very low matching with any of our existing funds. So clearly that shows that there is a very different style that at work here, and this period of underperformance we have actually been able to demonstrate a decent level of outperformance in these portfolios. The third thing is also in terms of matching of portfolios, we have ensured that the overall matching between the top holdings across our portfolios, even where the growth quality tilt is there, has been reduced. So all these things put together, we would say that we have been trying to tackle the issue of overall basket doing well altogether and not doing well altogether is tackled. There are also some changes in the fund and management team which will also help manage these funds in a different manner, where different fund managers bring their own thought process, their own style of investments, and hence there will be even further diversification from here on.
Thank you for giving a long and good answer, which is actually helpful. Now, last question on the Axis Bluechip. I think that to price to earning and price to book value, if we consider it, is still slightly higher than the peers and everything. Is it something which you categorically do it, or you would like to lower down your price to earning and price to book value in such a level where people find it attractive in terms of only that criteria?
Absolutely.
Or you find it no. So I have seen a lot of cases where even we say the price to earning should be around 18 to 20 or 22, something like that, but we have seen something whereas a price to earning of 45 has given a phenomenal return than the price to earning of 10, which has not performed.
Correct.
So just talking on only these two parameters, price to earning and price to book value, we find it is still higher among the peer.
Absolutely.
Do you think you would like to continue with the same strategy, or you would like to lower it down through changes in the companies and everything?
Sure. So very specific question to the fund, so I will try to answer it accordingly. But just before we go to the fund, I mean, just looking at the overall markets today, like if Nifty as an index, and if we compare its valuations compared to its history, or compared to the other emerging market indices, we will find that Nifty is one of the highest PE indices, and it still continues to do better. Now, just to understand what does PE mean, right? It's like what the premium that you're paying for the index or for the stocks in that index. If the stocks in that index are doing well, the quality in terms of ROE is good. If the growth in terms of earnings is higher, then the PE is justified, right? So there is a direct correlation between PE and earnings growth, and there is a direct correlation between price to book and ROE, right? That is how you actually compare it. In all these parameters, we still feel that Nifty as an index is better than its peers in terms of emerging markets and its own history in terms of, let's say, the last 10-15 years, which is where we feel that Nifty as an index is justified to have the PE that it has. Similarly, when we look at our own fund, as I said that we look at, let's say, a blue chip fund is primarily looking at as an investment philosophy of growth and quality, which means we are looking for companies that can consistently deliver at least 15 to 20% growth and 15% or higher ROE on a sustainable basis.
Yes.
A lot of businesses in various commoditized sectors, etc., will have ROE which moves from 0 to 25 in a matter of 2-3 years, again goes back to zero. For example, metals, etc. There you will find opportunities to get in at the right time, get out, which is a cyclical opportunity, and a business cycle fund can take care. But for a blue chip fund, which is looking for medium to long term growth opportunities, it does not really make sense to take big bets. It might take a few bets, but not an overall fund strategy to invest into cyclical sectors, because if the timing of that goes wrong, the fund actually can suffer a lot. And here we are trying to find businesses that can be consistent winners and give a lot of stability from an investor perspective. And at the same time, because these businesses generate high ROE, they are able to generate their own growth cash flow, which means if these companies don't need to attract a lot of debt for their growth or funding their growth or investments, and they also don't need to dilute the existing, so they don't need to again and again raise money from the markets, which means the existing investors can grow with the company as a compounding story. As you understand, equity is about compounding. 10 becomes 50, becomes 100 over years, and that's where the value is generated. If that 10 to become 50 needs the stake or raising money in between, actually the value becomes 25. So your growth actually goes to half. So dilution is not a good thing. And I'm sure you will agree that raising a lot of debt is also not a good thing, because that also can raise issues in bad times. So these sort of businesses, because of their inherent better quality of earnings, deserve a certain premium to their valuations, which is exactly what we see, that because our growth tilt is there in this fund, our premium is always there versus the benchmark as well as our competition. But what is important to understand is there's premium because in the last 2-3 years, a lot of valuations of our companies have not moved higher. In fact, they have fallen. Earnings have grown, but the price has actually remained there. So the valuations have actually fallen in terms of PE. But our competition, lot of players who were not into growth and quality, there the valuations have moved higher, be it a mid-cap, small-cap focused fund which has higher mid and small caps, or for that matter, a fund which will probably have a lot of, let's say, value stocks which have actually re-rated across the board. And hence the gap of PE between us and competition, as well as the benchmark, which was probably there 2 or 3 years ago, has come down. But the quality of business and the earnings of our business, it still remains at the premium that it is. So clearly we believe that to that extent we are in a good position. And as I again said, we have also made sure the changes that are done in the blue chip fund itself, we have added stocks which are now slightly more broad based, and hence the overall PE also has been slightly lower than what it would probably be with the portfolio that we had 3 years back. So both of these things we have taken care as a fund house.
Okay. So if you are an investor into Axis Mutual Fund, you came to know everything from the horse's mouth, who actually manages the fund. So I would request the investor that you should remain invested into the funds. Every fund house goes through a cycle which is up and down. You should not become impatient, and you should not be taking out the money only because of few quarter of underperformance or anything. If your goal is there and you are continuing with the goal, obviously the fund manager makes a lot of strategy behind the scene which probably is unknown to the investors. So just based on return, that 5 months I did not get the return, or 9 months I did not get the return, you should change the fund. That should not be the case, because that is the way the fund house is making the changes and probably may give you a huge growth in coming years. You had seen with a lot of fund houses where there was underperformance and suddenly they have come up. So I think that Axis, after understanding from him, I also think that Axis will come up with very strong performance in coming years. Now I will change it to slightly on a different note. You are managing this hybrid also. You know the debt as well as the equity, both. US yield is going up.
Correct.
And we are seeing that though in last 2 policy meetings he did not increase the rate, but he always talked very hawkish that we will not stop, we do not care about the banks and everything, we have to increase, inflation is our main goal. And we know that US economy, US is the market which actually drives the world market.
True.
China has not able to do well. They are going opposite. They are cutting the rates, but still their market is not performing. With this kind of yield, which I was checking yesterday, the US yield has gone past now 4.88%. The home loan of US is almost going to cross 8%. Historically, it's a 45 years high rate which they are into What do you think about the first in terms of the debt market in India? And India has a one good that JP Morgan has included India into the bond index, which we can see a lot of inflows into the Indian bonds also. But opposite side, the rate is going up. When we are doing this conversation, RBI has given a status quo report today that they are not going to increase the rate. As of now, they're comfortable. But yes, they may increase in future. Probably in December, they might go for. US may go for another rate hike or two. What your take on the debt? And if this kind of rate hike continues for a year, then what will be your take on the global equity market and Indian equity market?
Great questions. I think this is the backdrop that we need to understand before we start any discussion on the markets, right? Because inflation and interest rates have been one of the biggest impacts post-COVID that the world economy has seen. So very well put. I think just to take a step back, post-October 2021, as we came out of the COVID crisis, we started to see that demand itself was surging as the economies were opening up, but supply was not keeping pace because the biggest supply market for the world, which is China, lockdowns all the way till December 2022, right? So all that time period, we have had a basic mismatch between demand going up and supply not being there, which is where inflation started moving higher and the central bank started talking about increasing rates, which the thing that actually impacted this more and was a sort of shock to the system was the geopolitical crisis in Europe. Both the countries that were involved are one of the largest producers of steel exporters. They are largest producers for energy for Europe, as well as the fact that they also have a lot of food grains, etc., that drive into vegetable oil and other such markets prices. Now, this is where the pressure on the system was sort of extreme. And we started seeing US inflation being even higher than emerging market like India. There we saw a big increase in inflation and it has since then persisted. Now if we look at, let's say this year, China opened up, but we have not really seen a big demand coming up from China because they are themselves facing issues of their real estate being under a lot of pressure, which is about 30% of their economy, and there, because of their own policies, they are not growing faster. To that extent, they are also not seeing export-led demand, which means their economy is probably struggling at about 5%. US itself, and even for that matter Europe, is trying to put the brakes on the economic growth so that inflation comes down and then they can sort of look at it, taking interest rates lower. So in this scenario, demand is not a driver for inflation as of now. To some extent, in few of the commodities, you would agree that there are cartels which are working so that commodity prices remain higher. Now, if this scenario continues for longer, then inflation will not come down. We believe that that is not the case. Artificially prices being higher is not something, a scenario that can continue for a long period, and hence inflation, as soon as the developed part of the world, especially US, goes into a shallow recession, which means negative but not really a big negative in terms of recession, inflation should come down. A lot of the reasons for inflation are also the sort of money that was being distributed to people earlier across these countries, which has also now as a phenomenon come down. So as these movements are tackled, and one of the reasons why they would want to do that and bring inflation under control is because they also have a political event next year, which is the elections in November. They will probably want to show to the population that they are able to tackle inflation, not go into a deeper recession to do that, and hence the economy is under control. If they are able to manage that, that will be something that will be taken positively by the people there. Clearly, we believe that that can be one of the triggers where potentially interest rates can be lowered. And from that perspective, debt market in India also, I guess RBI in today's policy also mentioned that they don't expect inflation to be higher than or probably reach 5% in India by Q4. Their aim is to bring it down to 4%, while the range is 2 to 6 tolerance wise. Their aim is to bring it down to 4%. So they are not looking at loosening the policy very soon. But for them also to think of loosening, they will also need support from the global monetary policy easing. The reason being that we have not tightened so much. We have probably gone 2.5%. Whereas US has done more than 5. So this cycle has been something where we have neither loosened much more in COVID, neither tightened much more after that. But we cannot cut rates drastically before we see a big cuts in the global central banks. As such, for India, even with this level of interest rates, we believe that growth in general is not being impacted as badly. We have seen these levels of interest rates for India. And as you rightly put, US has never seen this for the last more than 40-45 years. years of interest rates. But the good part there is in terms of mortgage rate, the existing loans are on fixed rates. All of them rather. So to that extent, the existing homeowner is not impacted, but it does affect the new real estate owner situation, and hence they will not want interest rates to be structurally high there. As such, that economy is probably grows generally in the range of 2% plus or minus 1%, and there is not so much of population growth and demand growth to justify this level of inflation or interest rate. So structurally, we don't think that these are the rates that can continue in US for a long period of time. As soon as they tackle it and they manage inflation or bring it under control, these cuts should be at least visible or starting to get announced. On the global equity markets, again, it's a question of when the recession happens, if at all, or lower growth happens in these countries, and when we start seeing a next upcycle visibility for the developed world. From the Indian context, as we have said that flows from foreigners or FIIs will probably resume once the down cycle or the cuts are visible on the interest rates, and as such, any further impact on the Indian market will be without the foreign flows, will be dependent on how domestic flows continue from here on. One of the big events for us also is the elections in May next year. So policy continuity
We
on
have
the
state
overall
elections also.
Absolutely. So the direction of the national elections will also be visible, and people will start discounting a lot of that in the state elections that are happening in the later part of this year. But what is important to understand is policy continuity is what the market wants. The stability of policy, if it is there, markets will probably reward the overall index in that manner, or the vice versa. If there are volatile times, it will again react negatively.
Yes. So you have managing a lot of funds where in Axis, mid and small has given a phenomenal return in last 1 year. We started putting money as a MFD in 2020-21 into mid and small, and right now there is a phenomenal return as given by the mid and small cap funds. What is your take on that? Whether investors should start booking some profits, or they should remain continued in the things? What do you think that mid and small will go further higher? What is your take on mid and small?
Right. In a growing economy where we came out of COVID, there was a sudden spurt of recovery and growth that was visible across the overall economy, and that's where there was enough space for all these companies to grow. And as we mentioned, it was not only about one part or one section of the economy growing. This time around, it has been broad-based, which is where so many new opportunities have come up. So which is why we have seen high growth across many companies. Growth more than that, expectations of growth have been built, which are much higher, and hence the valuations have moved up. What did help that is while the FIIs were exiting lock, stock and barrel, domestics were putting an equal amount of money. The SIP flows have been so strong for the industry, and that is clearly a positive. But one also needs to build in caution, right? We have had two phenomenal years of outperformance for the mid-cap and small-cap index.
Yes.
I believe that from a Nifty mid-cap perspective, the premium to the Nifty now is more than 40%. Generally, it remains in between 15 to 20% range on an average basis over longer periods. So at 40%, it's clearly expensive. We have seen that in a high growth economic environment, these premiums have stayed higher for longer and have been maintained. But when the growth slows down, there are chances that the overall premium that is there for mid and small caps can come down. So yes, flows are important, on the one side. Second is the overall economic growth and space for growth. Because when the growth slows down, again large caps will get more aggressive and will be able to squeeze the mid and small caps, and that's where valuations can get hurt. Now, we are not saying that the overall mid and small cap space is going to be under trouble, but there will be companies and stocks which are fundamentally not deserving the premium or the valuations that they have got. There are many reasons that they have probably been benefited, such as China plus one, etc., which might not be permanent in nature. Whereas, if competition from China or some other bigger competitor comes up, they are not able to survive. Those are the businesses, the weaker business models, where the valuations can get hurt much more. And that's where one needs to be careful that if a bubble has been built in that space, we need to be selective. So I wouldn't say that all the mid and small caps are going to generally underperform. We ourselves have more than I guess 120, 130 companies in the mid and small cap funds put together, and we do believe that they are good business models that can continue to do well. So there are opportunities, but there are also pitfalls. So one needs to be slightly more careful, in that space now.
So investors who are mostly aggressive into mid and small should be careful, should not be worried, as the fund manager said, but careful.
Yes.
And you should always be careful with this kind of areas where there is a high growth, because it may come down, it may go up. So if you have a horizon of more than 10 years kind of a thing, it's okay. Sure. It may be aggressive towards it. But if your horizon is less, or if you really want the money in probably next 1 year or 2 year kind of a time to meet your some kind of goals or expenses, you may be careful and talk to your financial advisor on that part. So I would like to know how you see the gold and silver at this point of time. Metal, you said that it has been consistently being on the higher side and all those things. Do you think that if the stock market is going to come down or something like that happen, if US yield remain elevated for a long period of time, do you think that people will start moving towards gold, or you see that it will remain?
Sure. I guess gold is something that people move to as a safe haven. When there is nothing is going to work in the world, you have a scenario where suddenly big impact or big events are going to happen that can take down the global economy, where obviously equity takes a plunge, but at the same time even debt markets becomes riskier, right? Things such as wars, or let's say the Lehman crisis, those are the times when gold has massively outperformed. Even if you look at the COVID period, initially gold rallied about 20% in that period, where there was so much of uncertainty, where we didn't know anything what the world was facing. So those are the highly uncertain events where gold kind of protects an investor, and hence it's not something that we say that you should be 0 or 100 in gold, right? Because it's very difficult to time these events. These are events which are the unknowns. And hence there is certain level of allocation that one should always look at having in gold. Also, having said that, after periods of generally 4 or 5 years of underperformance, where money has moved to, let's say, higher performing assets, etc., we have seen gold outperform in those periods where uncertainty is there. Now, where is the uncertainty today in the world? For instance, inflation is high, and one doesn't know exactly when it will come down, which means interest rates are going to be high. I don't think any of us have seen interest rates in US being at such high level for such a long time in the recent past, and that can result into accidents. We saw a few banks in the US, for example, going into trouble start of the year. It could have become a bigger crisis, but it was taken care of. But multiple such events happening at the same time can be those events where we can have those accidents, and hence gold can suddenly rally. So one should be slightly more careful in this environment, and the best way to do that is actually have some allocation to gold as an asset. It does not really generate regular returns unless you put in something like a sovereign bond of RBI, but then other than that, it's really not an asset which generates returns. On silver, I think it's more of a industrial commodity. As the industrial activity increases in the world, it can do well. Plus the fact that there are a lot of new technologies and new areas such as EVs, where use of silver is also increasing. So that is a commodity that one needs to be more economy driven approach, unlike gold, which is more of a safety driven approach.
Safety driven. You are managing this special situation fund and this hybrid fund and the Bluechip business cycle, Bluechip, all this kind of. So can you tell me some of your key sectors holding in this thing, and what is the reason you are holding that? Sure. Like suppose if you are holding banking or FMCG at a higher level, why you are holding it?
So I guess the best way to answer this would be from a fund which actually looks at dynamic allocation towards sectors and keeps rotating, and which is the business cycle fund. I guess here the approach we are taking in financials is that if we are looking at an interest rate fall scenario, maybe 3 months, maybe 6 months down the line, margins for many banks can actually come under pressure. And on the other side, actually NBFCs can probably weather that time better. So we are in a scenario today where credit growth is strong. We are in a scenario where asset quality is one of the strongest. So from here on, things might start getting weaker from let's say 1 or 2 years down the line. But more importantly, if margins come under pressure, valuations of a few of these financials or banks especially can come under question. Hence, our weightage towards banks is lower. On the other side, weightage on the NBFCs, which are into microfinance, rural, as well as CV financing is higher. A second area where this fund has a higher allocation is towards areas which are growing faster, which is all the manufacturing areas that we spoke about. So it starts all the way from defense and then it goes to even traditional sectors like textiles, some of the chemicals sector where we have seen the profitability being bottoming out, and from here it should improve. Those are the cyclical areas that we have invested into, and also into things like auto ancillaries, where exports has become another big driver. These companies have been successful in India and now they are becoming exporters, either through their parents, etc. There other thing that we are also invested into this fund, some bit of exposure to metals. It's not a big exposure, but it's to say that there is now that much profitability that these businesses are able to generate, and hence some exposure there is warranted. Even in sectors such as sugar, we have some investments. And if I have to look at on an overall basis as the IT sector, there we are about equal weight at this point of time. The reason for that equal weight is that IT sector did quite well during COVID crisis, but post that there has been some slowdown, and worries of slowdown on the recession is what has resulted in this sector not doing well for the last maybe one year odd. Now what we are seeing is this quarter we don't expect great results, but as commentary starts factoring in recession and after that growth, IT sector should be something that one should watch out for. So our weightage there right now is not a big overweight, but it is something that we don't want to be completely out of also. Sectors such as consumer staples are not very big in this fund, but generally we believe that as the rural economy picks up, some of the FMCG names could be something to watch out for. And pharma also is not a big sector because it's defensive. In general, in pharma, we believe that spaces such as hospitals have done well and continue to do so in the healthcare space, and something like diagnostics may be something interesting from here on if competition becomes lower.
So, most of the people, most of the investors rather say, usually do not understand what is business cycle fund or a special situation fund. So, they understand large cap, mid cap, small cap, multi cap, flexi cap. To some extent they understand the flexi cap, but they do not understand what does special situation funds do or what does business cycle funds do. If you can, in a brief, you can explain that what special situation and what a business cycle funds do and how it can benefit the investors.
So, both of these funds are what we call are categorized as a thematic fund. In the special situations fund, we look at the name actually is slightly different from what we actually do there. We actually do innovation or technology led businesses is what we invest into in this fund. When it was launched, a lot of the companies in this space were probably not yet listed in India, but they were listed globally. Hence, we decided that we will have at least 20 to 30% of this fund into globally listed companies, where our Schroders, who has about 25% stake in Axis, advises us on one of their existing funds. They are able to give us a few stocks to invest into, and they do that on a regular basis. So that's where the global technology companies are invested into this fund. And in India, we have about 75% odd invested, where we have a broad spectrum of industries all the way from banking, financials to consumption to capital goods, and even a lot of high-end chemical companies that we have invested here. So clearly that is more of a technology focus, and then it comes down to industries in the IT sector, which we call as ER&D, or for that matter even online companies that have done reasonably well and have been listed now for a while. So obviously there has been a lot of volatility in technology company valuations, but now we are seeing that there is a clear differentiation between the winners versus the relative losers. The other part, so that's where the overall special situation fund is built in. So if I have to give as an example from a global perspective, I think the way to look at it is it's the NASDAQ of companies that we have. If you want to build a NASDAQ in India, that would be the right benchmark for this kind of a fund. So that's a special situations fund. The other is the business cycle fund. Business cycle fund, as we said, is more of looking at how business evolve in terms of cycle. As we understand, businesses have growth, expansion, and then they go into a sort of contraction. The overall economy does that, and then businesses also follow that cycle. Generally, a business cycle fund, people will find is that when there is expansion and high growth, there is a tilt towards banking or real estate kind of sectors. When the economy is actually falling, people move towards safer sectors like IT, pharma, and consumer. What we think is, instead of doing that, what one actually needs to do is to also look at sectors which can do well. In an economy like India, manufacturing as a sector has not grown at all. So there is an opportunity to actually look at individual sectors which can do well regardless of how the global economy or Indian economy is doing, and hence it's a mix of a business cycle which is run traditionally, where everybody would be crowding to the same sectors, and hence there are no great returns to be made, and also look at individual sectors that can do well, and as a blend sort of we have built a business cycle fund, and hence it's quite different from a lot of our competitors when we look at the portfolio as well as the existing funds of Axis.
Okay, nice to give the answers. My last question to you: which sector right now you find as a dark horse? Is it automobile? Is it IT? Or it is conservative sectors like pharma or auto ancillaries? Whatever you find as a dark horse at this point of time, which can be one of the best sectors.
I think on falls, I wouldn't say this thing, but one of the sectors, two sectors actually that could do well. One of them has been reasonably doing well, so I wouldn't say it completely. For instance, you mentioned IT. It is a sector that has been out of flavor for a while, underperformed till about June, July. It has bounced back a little bit, and every time now we are seeing that even with bad news, the stocks are actually coming back. So we know that last quarter was bad, guidance was bad for the full year. Still, the companies are back to the level that they were pre-result, even with disappointing numbers. It will be volatile, so there should be opportunities to look at this sector, and probably can be an outperformer from a 2-3 year perspective. The way IT industry is today structured, it is an industry that consistently grows at a decent rate with high level of cash flows, ROE, etc. And there is relatively lesser threat from something like China coming and disrupting them, and that's where this sector can grow. And the other sector, I think, is chemicals, where not every chemical company, but a lot of them have been impacted, because people fear that global economic slowdown will impact, and China being aggressive will impact chemical sector across the board. And that's where I think the differentiation needs to be made, that there are few businesses which are inherently much stronger and probably can do better in the medium term. And hence, as we get through this volatility in the next maybe 6 months, we'll start seeing that the differentiation in the chemical sector, especially the specialty chemical companies, will start getting and deserving the premium that they used to historically enjoy versus other commodity chemicals. So that can be another sector to watch out for.
Thank you, Mr. Ashish, for giving us this insightful. As investors, you must see the Axis Innovation Fund and the Business Cycle Fund. See, the special situation funds, always invested towards the innovation, and innovation leads to the next generation of the money. Like suppose if someone has invested Google in 2004, 2005, could have made a multimillionaire or billionaire kind of a return. So that special situation and business cycle are those kind of funds where people actually invest onto the innovation and to capture the different business cycles. Thank you, sir, for giving us this interview. And it's an excellent thing. You have explained everything. So again, I'm telling the investors that you should not be worried with a 1 or 2 quarter or 3 quarters of underperformance. If your goal is there, obviously with this kind of funds you can achieve the goal. But before doing any investment, this podcast is not about buying or selling of any mutual funds or recommending to buy and sell. Before you buy and sell any mutual fund, please talk to your financial advisor. Always remember, mutual funds are subject to market risk. So please read all scheme related documents before investing. Thank you for watching us. We will come up with this kind of podcast on a regular basis. Last time you have sent us a lot of questions. Same way, if you would like to send us questions, we would like to answer those questions. Thank you, Mr. Naik, for coming here and giving us this interview.
Thank you so much. It has been a pleasure interacting with you, and for the great questions that you have asked, which are much more insightful. Clearly shows that you have a lot of knowledge and insights into this industry.
Thank you.
Very much.
I will try my level best.
Pleasure.
Thank you, Fund.
Thank you.
Thank you for coming.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.